Why is it that some capital requirements regulations are still not sufficient?
The bank regulatory capital standards actually, oddly, allow banks to add back all of the losses that have resulted from higher interest rates. So a bank like Republic First that had hundreds of millions of dollars of unrealized losses on their books due to higher interest rates on bonds and loans, right, was permitted to add all that back. So superficially, from a regulatory capital point of view, they looked like they were in good shape when really it was easy to determine that they were functionally insolvent.
Fed Chair Jerome Powell told the Senate Banking Committee in March that there will be more bank failures, just not the big ones. Was he just trying to calm the markets, or is he correct in saying that there won't be a systemic banking crisis? Let's find out. With our next guest, Brian Graham. He is the partner at Klaros Group, former CEO at Bank Alliance, former partner at Blue Ridge Capital, and former senior vice president at Fannie Mae. This episode is sponsored by iTrust Capital. Welcome to the show, Brian.
Thanks for having me, David.
Let's start by talking about how many banks are exposed to a potential commercial real estate collapse. So, in your analysis that you've done in March, you showed that of the 4,000 banks that you've analyzed, 282, were roughly 7% of those banks, face stress from both commercial real estate and lower bond values. Can you elaborate on this?
Sure. There are two forces really hitting the U.S. banking system right now. There's the impact of higher rates. And when rates go up, if you hold fixed rate assets, loans and bonds, the value of those go down. Or put differently, when rates go up, the cost of funding your assets goes up. And if you have fixed rate assets, they don't change. And then the second is whatever is going to happen to commercial real estate. And obviously, we've all read a lot about post-COVID shifts in office behavior and what that's done to downtowns and in a variety of cities. There are also challenges in the multifamily space, the retail space, and a few others. And the combination of those two forces, the impact of interest rates and the impact of commercial real estate related credit risk, are really going to define the future next couple of years for the banking system. And from our perspective, while there are serious challenges there are lots of embedded losses in balance sheets of banks due to these two forces. The number of banks that are actually insolvent, that are at risk of failure, is quite small. So in that sense, it's a very different crisis than, say, 2008, or for that matter, the 1980s S&L crisis. There are fewer institutions that are insolvent and going to fail, and more institutions that are short of capital and need to raise some more funds.
Even if these banks don't fail, can we see potentially ripple effects for other communities outside banking?
Well, sure. Every part of the economy depends on the banking sector for its ability to fund its investments and grow and build out factories and start new businesses and all that kind of stuff. And when banks are undercapitalized, when they're stressed, they tend to hunker down. They tend to not make that next loan. They tend to not hire that next lender or relationship manager. And that's bad for the economy as a whole. But it's very different than the collapse of hundreds of banks that we've seen in past crises where you've got massive disruption. I'm not saying there won't be any bank failures. In fact, there was one a couple of weeks ago. It's just that there won't be hundreds or thousands of them, at least given the data we have so far.
Have you ever done any stress tests on how much unrealized loss a bank can sustain before they're going to have to write off assets or close shop? For example, how much does commercial real estate have to fall on their books before they realize a bankruptcy?
Yeah, so the simple way to do that is the average bank is going to hold about 10% capital relative to its total assets, right? So the value of those assets can fall as much as 10% before they run out of money. That's a lot, actually. It takes a lot to cause a 10% drop in the value of a bank's assets across the board, which is why it tends to happen in these episodic crises. In the 2008 crises, you had residential mortgages, the value of them dropping by 20, 30, 40% sometimes. Same with some riskier securities. Here you've got much more muted numbers so far, but still very across the board levels of stress impacting the whole system.
Before we continue, here's a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on itrust.capital/David to learn more on how to get started and learn about its unique tax benefits as well. If you sign up using my referral link, you'll get $100 in signing bonuses. I guess some people are wondering what the governments or regulators can do to further minimize the chance of a systemic banking crisis.
Well, look, simplistically, that's what capital requirements are for in U.S. bank regulation, right? The capital requirements were largely put in place in the 1980s in response to the savings and loan crisis at the time. And the idea of capital requirements is to ensure that private capital, that owners have skin in the game and have incentives to make sure that the institution doesn't fail. So really the thing for regulators to keep an eye on now is institutions that are very thinly capitalized or on a mark-to-market basis, potentially in rare cases insolvent. Those are the institutions where the incentives are misaligned, where management and owners might have the incentive to kind of take a lot of risk, sometimes called the mismatch between their incentives and the government's incentives. And if you have nothing in the game, it doesn't cost you anything if you take a risk and lose. And if you take a risk and win, all of the proceeds, all of the benefits, all of the profits accrue to the owners and management. And so keeping a very close eye on institutions that on a mark-to-market basis are close to zero in terms of economic value, that's probably the most important thing regulators can do.
Well, this leads to my next question, which is whether or not capital requirements or increasing capital requirements is sufficient. In a May 2nd blog post for Klaros, you wrote that for most past banking crises, which were dominated by credit issues, regulatory capital tracked true risk strength reasonably well. Unfortunately, a big part of the stress facing the U.S. banking system today is the result of higher rates, not credit. And the capital rules are doing a remarkably poor job of measuring that stress and identifying banks at risk as a result. And actually, a Republic First Bank was well capitalized as well, and it still failed. So walk us through your logic here behind that particular paragraph. Why is it that some capital requirements regulations are still not sufficient?
Sure. So again, keep in mind that capital is just the difference between an institution's assets and liabilities. But it matters how you measure both assets and liabilities to calculate that. And when you're looking at credit risk, right, the accounting systems and the way the regulators accept those for capital purposes works pretty well. You have a loss, it goes against your capital. You have an expectation of loss, and it's booked to your reserves. It goes against capital. So there isn't any mismatch there. On the interest rate risk side of things, the bank regulatory capital standards actually oddly allow banks to add back allow most banks, all but the handful of largest banks, to add back all of the losses that have resulted from higher interest rates. So a bank like Republic First that had hundreds of millions of dollars of unrealized losses on their books due to higher interest rates on bonds and loans, right, was permitted to add all that back. So superficially, from a regulatory capital point of view, they look like they were in good shape when really it was easy to determine that they were functionally insolvent. And the same was true for Silicon Valley. The same was true for this wave of bank failures over the last year and a half.
Okay. Now, in 2020, on March 15th, 2020, the Federal Reserve announced changes to its reserve requirements. I'll just read a paragraph from this post from the Federal Reserve. As announced on March 15th, 2020, the board reduced reserve requirement ratios to 0% effective March 26, 2020. The action eliminated reserve requirements for all depository institutions. This was before the failure of Silicon Valley and a bunch of others last year. Do you think this change was a mistake?
No, I think it had nothing to do with the bank failures, right? So that those reserve requirements are a technical requirement that relates to the relationship between a bank and its regional Federal Reserve Bank and how much money it has to hold or not at the Federal Reserve Bank. And these days, there are lots of ways to satisfy a bank's need for liquidity, not just at the Federal Reserve Bank in their particular region. So I don't think that mattered a lot. Increasing the interest rate to fight inflation mattered a lot, right? Because again, that caused the value of fixed rate assets to go down. And if you weren't well hedged,
Hmm.
like Silicon Valley, like First Republic, like for that matter, Republic First, which failed a couple of weeks ago, that was that's cause and effect. But the reserve requirement's really a very separate issue.
Okay. Now, last year, in the wake of the failure of Silicon Valley Bank, Signature, and First Republic, you wrote in a blog post that out of this cacophony, a clear picture is emerging of both the longer term winners and losers, principally regional banks with between $75 billion dollars and $250 billion dollars in assets. And I think the winners you highlighted are bigger banks, including JP Morgan. So, what is the long term implication here? Are we going to see more consolidation and more value added for the larger banks?
Well, look, I think the long-term implications depend very much on the approach policymakers take to bank mergers and acquisition activity, to consolidation, because they have control over whether or not a particular bank merger is permitted and can stop them if they want to, even for reasons that they don't have to articulate. But regardless of what happens to consolidation, which is within the control of the policymakers, what has happened is a very significant increase in the fixed costs of being a bank, principally due to two factors. The first is regulation itself. If you think about it, all of those requirements for compliance and for process and for governance and internal controls and back checking and all those kinds of things, which are very good tools for reducing the risk to a particular institution, they have a cost to them in terms of people, in terms of systems, in terms of investments. And those costs are pretty much the same whether you're a $100 million bank or a $10 billion bank or a $50 billion bank. And as a consequence, when fixed costs go up for regulation, it creates an incentive for an institution to be bigger, just like in the automobile industry or aerospace or food services or anything else. And the second factor, which operates in the same way, is technology, which is, we've gone through the COVID pandemic. All of us, including my mother, learned how to use their phones to do mobile banking. That's really changed the importance and accelerated the imperative for investment in technology as a banker. You need to have a really good mobile app, and you need to have the ability to provide people with the information they want and the way they want it, et cetera. That also requires a big investment. Those investments similarly are not very well connected to asset size. And again, bigger is better when you've got a fixed cost. So there are huge incentives for banks to get bigger. The policy overlay makes this a little more interesting and a little less simplistic than just bigger is better, right? The policy overlay is that we've just shifted the line, the dividing line between more intense supervision and kind of normal supervision from $250 billion in asset size to $100 billion. They did that in the wake of Silicon Valley. That doesn't matter to the largest institutions in the country, to the JP Morgans and the Wells Fargos and Bank of America. They've been there already, right? And they benefited from a flight to perceived too big to fail protection, the perception that the government will bail them out regardless for a long time, and certainly benefited in the wake of the Silicon Valley stuff. But if you're between, pick a number, 50, 75, 100 billion in size as a bank and 250 billion, you basically are now subject to the same rules as JP Morgan, but you're 1/15th, 1/20th the size. And it's unclear whether the regulators will permit consolidation amongst those, M&A activity amongst banks that size to gain that scale. So that's a really tough place to be. Pretty good to be at the largest end of the spectrum. Pretty hard to be really tiny, $100 million bank, and there are thousands of those in the United States, just because those fixed costs are hard to pay for when you've only got $100 million in assets. But that 75 to 250 billion in asset zone is a pretty tough spot.
I guess for investors, then investing implications, is this a call to long, I guess, the larger banks and short the regional banks? Would that be a fair play?
Well, I'm not going to take a position on investments because you got to understand
Yeah,
what the price is of the investment,
right,
right?
right.
And, any of these investments could be any of these bank stocks could be a good investment or a
Sure.
bad investment, depending on where you can enter. I would say there are more headwinds for the 75 to 250 billion dollar asset banks than there are for the trillion-dollar banks, or for that matter, that there are for the $10 billion banks. How that balances out from an investment point of view, I don't really have a view on right now.
Well, let's just do some um fantasizing here, like a thought exercise. Suppose we were to reverse engineer a scenario in which the banks that are deemed too big to fail start failing. What scenario would that have to be?
So interestingly, as I said a bit ago, the capital rules that for most banks allow them to add back these unrealized losses due to interest rates, right? That doesn't work if you're JP Morgan. You've had to deal with the consequences of unrealized losses. And so it's not a surprise to me that because of that, because the measurement systems take into account interest rate risk for these big banks, they managed it, and so very few of them had really, really large interest rate risk losses, unrealized losses over the last couple of years. So that's good news. Second piece of good news for the biggest institutions is that they are quite well diversified. They obviously have exposure to commercial real estate, but nowhere near the same extent, that same percentage, same proportion as the regional banks or community banks. And that's not because they did less commercial real estate. It's more because they were able to do things that are also scale businesses that the smaller banks can't do. Credit card programs, for example, are a very scaled business. Lending to big projects, dams and solar farms, and to the largest corporations. Those are all kind of scale businesses that the big banks can be in, that the smaller and mid-sized guys can't. So there's that from a substantive point of view. And then from a regulatory point of view, over the last 10 or 15 years, we've really imposed a pretty heavy burden and responsibility on those largest banks to maintain a higher level of capital, and that makes them less risky. So I think right now, at least, you'd say there's nothing in these two big forces, interest rates and credit and commercial real estate credit, that is a serious cause for alarm for the handful of largest banks in the country. But you never know. That's both the beauty and the curse of banking. Is the future is always something different than you expect and forecast. So right now it looks fine, but
Okay.
hard to tell for the future.
So, if we're to stress test this further, even if the economy falls into a recession or even if interest rates remain higher for longer, the banking system, the larger banks at least, can still withstand these shocks.
So I would say with respect to interest rate risk, and we're talking the largest, 10 or 15 banks in the country, with respect to interest rate risk, the answer to your question is yes. I think they're well positioned to withstand that. With respect to a recession, it depends, how deep, which sectors, how serious the resulting credit risk issues are, what are the kind of follow-on effects for other sectors. Clearly banking is an industry that's tightly correlated with the underlying economy, and that's true for the largest banks as well as the small banks. So
Hmm.
no bank is immune from that.
Okay. Let's just evaluate commercial real estate for just a minute. Now, the Federal Reserve said last week that the rate of late payments on some commercial real estate has surged. And so, in a note, they said improving the speed, force, and agility of supervision as appropriate is something that they're aiming to do. Now, can we evaluate this statement? Is it true that the rate of delinquencies going up is a concern and this trend may continue?
Well, the first part of your question, yes, it's a concern. that delinquencies are increasing on certain types of commercial real estate loans. Um, I view delinquencies as a very lagging indicator because that only happens long after kind of the facts on the ground have been apparent to the lenders and to the owners of the property. So I don't view it as a particularly good leading indicator, but certainly any increase is of concern. I'm much more worried about. I'm much more focused on the properties that have experienced a significant decrease in their revenue, right? So if you're an office building and half of your tenants no longer need the same space and they cut back, and that's caused your rents to go down, as an example, and or situations in which your operating costs have gone up, so insurance costs, the costs of you know staffing a nursing home, the costs of getting plumbers and others to come in, the costs of just simple electricity and other utilities. And critically, where the cost of owning that property has gone up, which is largely a function of interest rates and when you refinance the debt you're using to own that property. And the combination of those three factors and how they play out in specific types of commercial real estate, multifamily, retail, industrial, et cetera, how they play out in different areas of the country, that's going to be what we have to watch. And I wish there were a simple answer to it, but it's going to be very different in the suburb than it is in the center city. It's going to be very different in the Northeast than it is in the West. It's just going to be different.
Okay. Now, suppose we don't have bank failures from rising commercial real estate delinquencies, but would commercial real estate failures affect the valuations of some of these regional banks, just from a stockholder's perspective?
Well, I think uncertainty regarding the future credit performance of commercial real estate has already impacted the valuations of all banks. That uncertainty has expressed itself in lower multiples to pick your measure, book value and other things that have hit all banks. It's hit some banks harder than others, largely based on the proportion of a bank's balance sheet dedicated to commercial real estate. But right now, I think no one really knows for a given bank, for a given geography, for a given set of loans, whether that's a loan portfolio that's going to do just fine, or that's a loan portfolio that's going to really face challenges. And sorting that out will be the business of the next couple of years as more information comes down about the performance, the ability to refinance, or the requirement to extend or modify these loans. That's going to be where we really start to learn, how things are going.
Okay. Well, is it possible that, well, first of all, so you're saying that the risks are already priced in, more or less?
No, I'm saying that the market is already reflecting the fact that there's commercial real estate uncertainty and concern. I have no idea whether the market is accurately pricing in the real risk for each of these institutions. In fact, I think it would be very hard to do so because from the outside, it's hard to tell whether a given bank's loans are, as I said, are relatively good or relatively bad. You just can't tell from the information that's available.
Okay. Okay.
Go ahead.
Is it possible that the commercial real estate issues or crisis, whatever you want to call it, is more or less over? And here's why. I'm reading this article from Reuters that came in just today on the 14th. Some of the world's largest investors are making deeper inroads into lending to commercial property as they snap up market share from retreating banks and bet on an end to the sharp drops in real estate prices. U.S. fund firms PGIM, LaSalle, and Nuveen, Canada's Brookfield, among others, are all adding to their exposure to credit and credit exposure to property, that is. Is this a sign that fund managers are seeing an improvement in commercial real estate ahead?
It's a sign that they're willing to bet that they can kind of box the bottom here in certain asset classes in certain areas. And I think that's great because otherwise you could have a market dislocation, the inability to finance something create more trouble than is actually substantively there. I don't think that though says that we're out of the woods with respect to bank or for that matter non-bank credit exposure to existing commercial real estate loans. that's still going to take a number of years, a couple of 3 years to work its way through the system as these loans mature, as investors decide whether or not to put more money in, as bankers and lenders decide whether or not to extend the loans, et cetera. It's going to take a while. So even as new entrants come in to make loans on the edge, which is a great sign, I think we've still got some wood to chop going forward.
Okay. Finally, what is your view on interest rates going forward? Do you think the Fed will cut rates this year?
I have no idea. If I knew, I wouldn't have to work for a living. Like, look, I don't know. I operate my business on the assumption I don't know
Right.
whether rates go up or down. And I'm highly skeptical of people who are highly confident that they know which way it's going to go. All I know is that it's highly likely that rates aren't going to be zero again anytime soon, and that's enough to kind of inform an approach to thinking about and analyzing the banking sector.
I remember a few years ago asking some people about where rates are going to go, and we had this discussion. And some people told me that it was unlikely that the Fed funds rate could go to 5% because that would mean that interest payments alone would wipe out a lot of companies. It would put a lot of stress on the Treasury. As you know, $1 trillion in interest payments. It's about a third of tax receipts nationally, right? But here we are, 5%. Were you surprised that this happened without a complete collapse in the financial system?
No, look, I'm old enough. I've been around a long time. I'm old enough to remember 25 or 30% interest rates. So I remember when Paul Volcker jacked up the Fed funds rates to almost 20%. These things come and go. They come and go in waves. We tend to assume that what we've experienced for the last X years is going to be the future no matter what. I think the right answer here is to assume that things can be anything, and hopefully to prepare yourself as best you can for whichever direction they head. So I have no idea what's ahead. I think it'll be interesting. I know it'll be challenging.
The argument with the with interest rates being higher before I've heard is that in Paul Volcker's days, the nominal value of debt was a lot lower, even inflation adjusted, than today's value of debt. And so because we have more debt, it's less likely the system can sustain higher interest rates. I mean, is there any truth to that?
Well, I would put it differently. I would say because the federal government and other parts of the governmental system have more debt, the consequences of higher rates express themselves pretty quickly through the P&L of those governments, right? Through higher interest expenses. But the only way to avoid that in this circumstance over the last couple of years would have been to accept very high inflation, and that has consequences too. I think the Federal Reserve did what their mandate is, which is to manage inflation, and they're still working on it, and they may have a ways to go yet. We'll see, but I think that's exactly what has to happen. And then the consequences of higher rates play out through banking sector balance sheets and consumer household income levels and disposable income levels through federal government P&L as well.
Okay. Finally, tell us about Klaros Group, the work you're doing there, some of the more recent research that you're doing that you find interesting, or I'm sure it's all interesting, but some of the highlights of your more recent research.
Yeah, so Klaros is an advisory and investment firm. We work at where financial services kind of intersects with banking and innovation. We think that's fun and interesting, and and right now we see the biggest investment opportunities in helping banks kind of dig themselves out of the consequences of the higher interest rate and tough commercial real estate environment. And we see enormous opportunities for innovation on the part of fintechs and banks and private credit platforms to take advantage of this dislocation to make sure we keep delivering, credit to the businesses and families that need it.
My younger friends just want to know if they're going to get laid off from their junior banking jobs because of AI. I don't know if you've looked into that.
Like interest rates, I'll take no for this.
All right. Thanks very much for your time, Brian. Where can we follow you and your work?
Klaros.com is the easiest thing. So thank you for your time, David. Appreciate
Okay.
it.
We'll put the link down below so people can follow Klaros Group. Thank you very much again, and we'll speak soon. And thank you to the audience for watching. Take care.